The Kenyan government has recently moved to offload part of its stake in Safaricom, a decision that is drawing both interest and intense debate. According to the government, the National Treasury Department, the partial sale is part of a deliberate strategy to mobilize non-tax revenue for the country's development agenda. And by selling 15% of its stake at Safaricom, the transaction is expected to raise at least 240 billion Kenyan shillings to 245 billion Kenyan shillings, which will provide seed capital to the National Infrastructure Fund and the Sovereign Wealth Fund. And this is targeted at financing energy, transport, water, digital, and other strategic infrastructural projects. Now, the officials say that the sales was done at a premium price over the recent market trading prices, designated to maximize returns while still preserving a significant strategic stake. Moreover, this divestment is portrayed not as an abandonment, but a reallocation of resources and redirecting a mature, high-value asset into a new investment that could stimulate long-term growth of the country. Some of the arguments as far as this sale is concerned is that the roughly 240 billion Kenyan shilling from the sale provides the government an immediate funding source for major public projects without having to borrow or raise taxes. And by using non-tax revenue instead of new debt for development, that move could help stabilize public finances and reduce reliance on borrowing. And of course, the government still retains a significant holding of about 20 to 25% in Safaricom, preserving its influence in the governance, data protection, infrastructural control, and regulation. And of course, the government says that privatization and privatizing the part of the stake signals confidence to investors, potentially boosting market interest rates, increasing competition, and stimulating efficiency and innovation in the long term. Some of the criticism of this move is that uh, while people like Dindi Nyoro argues that the sale price was about 34 shillings per share, undervalues Safaricom and the company could be worth more. And while the sale brings a lump sum now, it reduces the government's share of future dividends from a profitable company, potentially sacrificing stable long-term income. And of course, Safaricom plays a central role in Kenya's telecommunication, digital financing services, data and infrastructure. Reducing the state's stake may limit its influence over key decisions. Those are some of the arguments against it, but overall, in the government's offloading of Safaricom shares appears to be a calculated move, converting part of high-value, mature asset into cash funding infrastructure, reducing fiscal pressure and encouraging private participation while aiming to retain strategic influence. Yet it carries real risk like potential undervaluation, loss of long-term dividend, and reduced control over national significant company. Yeah, that's my take.